So what is Westwing? So Westwing is a European direct-to-consumer online home furnishing retailer. The unique things about Westwing is its content-led strategy has leads to very strong user engagement and great cohort economics. So why is this position potentially interesting? First off, the industry has been struggling from a cyclical downturn post-COVID that they're just beginning to see the recovery of. So obviously, during the coronavirus, a lot of people over-indexed their purchasing to home furnishing. So they bought a lot of, rugs and lamps and stuff to decorate their living space because everyone was at home. That led to a significant downturn in the industry as people's purchasing patterns normalized post the pandemic. One of the good things about the pandemic, though, is it materially improved Westwing's competitive environment. So whereas previously they had a lot of well-funded, aggressive competitors, now many of those competitors have left the market, leaving them in a better position for the upturn. They also used the downturn to do a multi-year strategic transformation, which has greatly simplified and improved the underlying business foundation. And as a result of that better foundation, they've actually began to significantly expand into multiple new countries in Europe in 2025. However, this improved business performance has not actually shown up yet fully in the 2025 results due to the transition and the ending of the transformation, which has artificially depressed those results. So we're getting, basically the progress has been made, but you actually don't quite see it in the numbers yet. So just briefly, how do we think about the upside here? If they return to kind of the double-digit top line growth and get to, improved EBITDA margins, I could see the stock easily getting to 45 euros a share versus the price of sub 12 as of 10/23. On flipping that around, on the downside, I think Westwing has a very strong balance sheet with a substantial net cash position. They've proven to be shareholder friendly with that cash. And they also have a very sticky customer base. That combined with just their valuation on their 2025 results should provide solid downside protection at 9 to 10 euros a share. Obviously, there are risks. One risk is that the online home furnishing addressable market in Europe is smaller than we expect. They also still are exiting the transformation, so perhaps they could miss guidance on near-term results. If they make mistakes with their content or brand, obviously, given their emotional attachment with their customers, that could be damaging. They also could have logistics issues. These are challenging things to ship. And then I guess finally, a continued or worsening European economic downturn could hurt consumer demand. And obviously, there are probably other risks outside of this as well. So in more detail, here's a little bit of brief business overview on Westwing. So they sell home furnishings in 22 countries in Europe to over 1.2 million customers. It is a premium assortment, so kind of upper middle class and above, and it's mainly a female customer base. So it's mainly home decor, so it's a lot of like lamps, decorations, but they do also sell things like couches and rugs and things like that. It's a very loyal customer base. So 80% of their orders come from repeat customers, and they used to talk about a metric basically being that their customers would visit 90% of their customers would visit either the email or the site or their online thing at least once a week. So there's a tremendous amount of customer interaction with their content. Home furnishing is obviously a very large addressable market, and it is still shifting online. In Europe, the shift is still well behind where we are in the US. Westwing currently only has 0.3% market share of this 150 billion addressable market. The market has been aggressively moving online, and there's still substantial room for it to move online in the future. One of the nice things about the downturn, if you can call it that, is the competitive environment for Westwing has substantially improved. So if you look back during COVID, they had multiple venture-backed players and well-funded players, including Made.com, Wayfair, and Home24, who were all aggressively competing. Made.com was probably their closest competitor. It's a UK company that during COVID had started to aggressively expand into their core European markets. But they ended up getting massively over-inventoried and didn't fix their cost structure. So in 2022, they actually liquidated. Home24 was another German e-commerce player. It's was a lower quality player than Westwing, but they were still a competitor, and they had to be rescued by a brick and mortar player, XXL Lutz, in April 2023, and they're not nearly as aggressively investing in online anymore. There've also been some shuttering of brick and mortar chains like Depot and Opti One who filed for insolvency. And then finally, obviously, U.S. Competitor Wayfair, in the COVID period was substantially investing in European marketing, really trying to make a push there. They've been pulling back on this marketing investment for multiple years now, and they actually exited the German market in the start of 2025. So if we look at it going forward, many of these well-funded competitors are no longer there just as the industry is about to enter an upturn. And so that should allow Westwing to take substantial incremental market share as demand recovers. The other interesting thing about Westwing is the Westwing collection, which is effectively their private label brand. It's become a significant portion of the revenue base, representing roughly 2/3 now at the most recent quarter, and it's very well regarded by their customers. It is their best sellers, well reviewed, and private label makes a tremendous amount of sense in the furnishing industry because you have a very fragmented supplier base who don't generally have that strong brands. So it provides Westwing significant bargaining power and the ability to kind of use their brand as the leading way to approach customers. Collection revenues have done very well, consistently growing at high double-digit rates, and they are significantly more profitable than the third-party product for Westwing. So continued shifts in this direction will help margins. As I mentioned at the beginning, Westwing is very focused on content. So they are the largest home and living brand on Instagram with 8.6 million followers, and they have over 13 million followers on social media. Unlike a lot of their competitors, they have internal studios where they produce their own content. So they're taking their own pictures of their products as opposed to using stock photos like a Wayfair. And that allows them to much more attractively place their higher end products for their customer base and create substantial content that leads to this repeat customer interaction that drives this kind of long-term sticky relationship. So one of the great opportunities here is, they have 8.6 million followers on Instagram, but 1.2 million customers and 13 million, actually, if you think about all of social media. There's a huge market that already knows who Westwing is and already is interacting with their content that actually isn't shopping there yet. And so as Westwing continues to improve their commercial operation, there's room to substantially increase their customer market share. The other interesting thing here is, Westwing used the downturn to do a substantial shift of their business. So in 2022, when the company had basically two business models, they had Westwing Club, which was more of a daily deal type model, and then the normal e-commerce model. And both of those had fully separate tech stacks and fully separate, basically, commercial operations, which was wildly inefficient. So in 2022, 2023, they combined those together in the one Westwing commercial model, which greatly simplified the business and allowed them to kind of benefit more from their scale. They also took a significant organizational right sizing and cost reduction, which basically fixed their cost base for the new demand environment and left them in the position to play offense when the business improved, as opposed to their competitors that were slower to react and ended up getting in trouble, as we discussed before. So this was the first step. The second step was they worked to build a scalable platform. So they changed their product assortment to move it up market and into the more premium area. They also transitioned their backend to an external SaaS provider, Shopify, who basically significantly improved their commercial operations. And listening to the management team describe it shows kind of how logical they are. They, as they put it, when we were founded in 2011, building our own e-commerce engine was a true differentiator for us. But at this point now, given the quality of the external tools, it no longer became a point of differentiation. So they decided it was better to outsource to someone with greater resources. Again, a very logical decision. So these improvements have set the company up to now begin scaling again in 2025. So they've started with a significant country expansion. They're working to increase their market share, which should allow them to grow their top line with expanding margins. So the first step of this is substantially expanding the countries they're in. So at the beginning of the year, they plan to roll out to 5 to 10 new countries in fiscal 2025. they've actually had really strong results. So they've actually already done the 10 countries of year to date. This chart's a little wrong because Romania was done in late September 2025. And they still have substantial room to expand to other European countries, and that is on the plan. This will give them a much bigger addressable market to attack and more room to grow with their existing improved commercial operation. But the good thing is these improvements haven't yet shown up in the results, which might explain why the stock is mispriced. So in 2024, Westwing made the choice to upgrade and globalize the product assortment. So basically, they went to a more premium model and they centralized more of the assortment as opposed to having more like unique things in Italy and unique things in Spain. As a result, this has hurt 2025 revenue. They have talked roughly as it being, kind of a mid-single digit, low mid to high single digit impact to revenue. So as opposed to kind of flat revenue guidance, you'd think that pro forma for this growth would have been mid to high single digits. And you can see, generally they've been very much at the higher end of their guidance for the last few years. So I think they guide relatively conservatively. They've also hampered the EBITDA margins. So while the guidance for this year has substantially better EBITDA margins, they're actually not as good as they probably should be because there are ramp-up costs for each of the 10 new countries they entered during the year. Initial marketing spend is less efficient as you have to build a customer base and bring your brand to customers who don't know them. And so this massive country expansion has had a significant impact on 2025 EBITDA margins. Um, and so, if you look at these, the change for the local assortment, which was very inefficient, and also so the drag for that for the top line, the drag to the margins from the country expansion, and you could actually argue that 2025 results should be much higher than what they have guided for. And as a result of this, they've at least started to talk qualitatively about 2026. So, revenue growth now, once they're past the assortment change, should accelerate in 2026. They should also get the benefit from the country expansion because a lot of the countries in 2025 were launched in the middle of the year and they also take a long time to ramp. So they should actually scale in 2026, allowing for substantially faster growth. They have talked about an ambition of upper single to double-digit growth in 2026. And again, I believe based on my history here that they generally guide quite conservatively. They also talk about improvements in profitability in 2026. While the country expansion hampers margins, these countries tend to be profitable quite quickly. So the first country they entered was Portugal, and while it was loss-making initially, it became profitable within 1 year. And they've commented that they really believe they have a clear path to a 10% plus EBITDA margin. This management team is, long tenured, and they are, in my opinion, really, hold them in very high regard. So Delia Lachance is the chief creative officer. She was the founder, and I would say consider kind of the creative muse for the company. She is, her Instagram following is substantial as well, and she's considered kind of a style leader in Europe. Andreas Horning is now the CEO. He was previously the chief commercial officer, and he was responsible for the Westwing collection, which I think will be a driver of substantial success. Sebastian Westrick also has e-commerce experience previously, and all of them have impressed me with their focus on, they've been willing to take, near-term pain with a focus on generating long-term returns. And I think they have a great long-term orientation. They've also bought shares in the company multiple times over the past couple of years. Again, another example of, their capital allocation has been very strong, so they're shareholder friendly. While they have, had excess cash, they initially did a normal repurchase of shares, which was somewhat limited by the volume in the market. And so in November 2024, they announced a tender offer for 6% of the shares outstanding. This is actually pretty outside the box thinking in a German company. These tenders offers are not widely used there. And it shows their willingness to think in an aggressive shareholder-friendly manner. So at this point, they actually own almost 10% of the company in treasury, which is what they're limited to own. So they will either have to start retiring some shares, which they can't do quite yet, but they should be able to do, in 2026. And then that will also give them some room to repurchase more shares. They're also willing to talk about how they think the share price is undervalued. So in recent decks, they've started talking about their valuation based on analyst consensus, and they've also talked about, shown how they've cut the number of shares in circulation. Again, these are relatively abnormal things for a European company. So they are thinking on behalf of shareholders. So how do we think about the upside valuation here?